Hi, everyone. Welcome. Thank you for your patience as we navigated some tech challenges. But my name is Ellie Bahrmasel, and I am thrilled that you have chosen to spend part of your day with me today. We're going to go ahead and share our screen and dive in. If you haven't gotten a chance to take the poll and let us know where you're situated today, would love to hear from you where you are in the world. We are going to spend some time together talking about de-risking early stage investments. In the chat, we'd love to know what your role in the ecosystem is, whether you're an investor, a founder, an operator, or someone who's just curious about this topic. We're going to do our best to be informative and insightful today, and hopefully you walk away with a little bit of information that you didn't have before. I'm going to go ahead and share with you my screen. I apologize if the view isn't super clear. Again, having a few technical difficulties this morning, but we're excited to dive in. So before I get any further, you might be wondering who I am, who we are as Further Faster, and why we care about this topic. Further Faster is a studio that essentially serves as fractional CPOs for early stage startups who are trying to prove product market fit. We support founding teams with everything they need to get to product market fit, and really believe strongly in a de-risking testing mindset to get to product market fit more quickly. But oftentimes we encounter both founders and investors who want to better understand this de-risking mindset and what's the methodology we can actually apply day in, day out to our venture creation to de-risk. So we've done this with over 50 early stage teams in the past 3 years. We've also helped create 4 accelerator programs and helped develop 1 fund thesis using de-risking methodology as the cornerstone of our framework for how we build. So let's talk a little bit about product market fit. When we talk about product market fit, it can mean a lot of different things to different people. But it's important for us, for the context of this conversation, to share one definition of how we talk about this. We want to acknowledge, of course, though, that for a topic like product market fit, there's a million different opinions about what this means. And we want to present one point of view. Simply, it's ours that we've developed over the course of our time together, not just as Further Faster, but as a leadership team. The founders of our studio have respectively raised $40 million for their previous ventures and have, in addition to being founders of their own ventures, worked with countless early stage teams as first hires or supporting consultants over the course of our careers. There's so much nuance here, so please, if there's something that we share today that maybe doesn't fit the way you've thought about product market fit or de-risking in the past, we'd love to hear from you. My contact information will be on the screen before we wrap today. And we have a diverse audience joining us. As I mentioned, some of you might be founders, some might be investors, and others operators. Some just might be curious about this world of venture more broadly. So this may feel like a broad perspective on de-risking and highlighting examples of what this might mean for you in your context. We would need far more than an hour to nerd out in the way that we would love to nerd out. So please see this as a high-level introductory overview to what we mean by de-risking mindset. All right, so let's dive in. When we talk about product market fit, it's usually hinged around 3 cornerstones, being first, that the founder has identified a big enough problem for a big enough market, that the founder and the founding team has built a product to solve that problem in a way that customers will pay for, and that you've done so in a way that delivers the product at a growing rate year over year with a positive ROI. Okay, 3 things. That might sound relatively simple and straightforward. except it's easier said than done. Whether you're a first-time founder or you're on your 37th founding team, what we know to be true is that there are many obstacles and a big lift to getting to product market fit. There are three core things that we want to highlight today. The first being time and money. It takes a lot of capital and a lot of time to hone in on those three things that we mentioned on the previous slide. There's also a misconception that product market fit is a one-time occurrence, which anyone who's been on the entrepreneurial merry-go-round for a while knows that's absolutely not true. There are so many unpredictable variables that exist, changing markets, new competitors that enter, and frankly, human beings are fickle. What they love today, they might not love tomorrow. There are new trends and fads. There's new cultural hallmarks that inform the way people see the world and what they prioritize. And we learned that very quickly coming out of the past couple of years of the COVID pandemic. There were companies that seized the moment and saw what people needed and wanted, especially in the earliest days of quarantine. And while they experienced exponential growth in those early days, whether we're talking about home fitness or language learning or remote learning platforms, as the world has opened back up, consumers want something different. So many variables at play. And for those companies to continue to thrive, they have to be really immersed in this ongoing cycle of product market fit, which we'll talk about in greater depth. And then repeat failure. Failure is inevitable when you build a startup. And we're not talking just about that big macro failure that gets the TechCrunch headline. Day in, day out, if you're doing your job well, there's lots of middling and mini-size failures that occur. So how do we de-risk all of these things and make sure that we're using our time and capital effectively, that we really have a tight ongoing cycle that allows us to de-risk, and we build the resiliency to leverage those failures in meaningful ways that de-risks the company in a way that hopefully reduces the likelihood of that capital big F failure. So the question we've asked ourselves, and we've asked all of our partners, is how do we create a process that ensures we're taking calculated risks, that we're learning as much as we can along the way, and most importantly, that we don't fail catastrophically? There's lots of different camps of thought, and we're here to share one with you today. And that's about the minimum viable testing mindset. You know, de-risking and minimum viable testing is really a mindset. It's not just a set of things that you check off your list as you do them, but it's a way of building, and it's frankly a way of being that you see people embody, not just in the way that they're building their product or their company, but how they move through the world more broadly. Why we're so passionate about minimum viable testing is it asks teams to break things down into bite-sized hypotheses, starting with the riskiest assumptions, and find quick, easy ways to get validation from the market. And by market, we mean our desired end user and buyer, in a way that helps us make the right decisions so that we can focus that time and money in the right places. We also think it's important, though, before we talk about this methodology, to understand what are a founder's biggest risks. We all know the big one, failure. And we could argue whether or not that's truly the biggest risk, because if you fail, there's so many great opportunities that come out of it. But let's dig a little bit deeper about what the biggest risks are, particularly for companies that are in this pre-seed through Series A universe. Coding something that nobody wants to pay for is one of the biggest avoidable risks that we see day in, day out with the founders and investors that we work with. Often you have a shower thought or a big, brilliant aha on your run and decide this is the thing that we should go build, and spend a ton of your financial resources going to code, putting something out in the world that you didn't get feedback on from the user. Or if we got feedback in a very macro way, and we don't understand in detail what features are the ones that people will actually pay for. There's also a big risk around building around a market segment that is too small or too difficult to reach. Now, I want to be clear, there's nothing wrong in the earliest days about getting very niche and learning from a small group, but we have to quickly figure out, how does that tie into a broader market segment that scales? We also see that not having a clear understanding of the competition is a huge risk. And when people talk about competition, they're often talking about who's a direct competitor. But if someone's got an urgent enough problem that they are seeking a solution like the one that you're building, they are absolutely solving it in some way, shape, or form, even if it's not a direct competitor. So how do we figure out what that looks like, test hypotheses around that, and get greater clarity on where the real competition lies? And then, of course, hiring a team that isn't right for your market, or hiring the right team, but too early. When you've got the right validation points that come from a de-risking methodology, you can sequence out your talent pipeline in a way that makes right talent and right product merge seamlessly. So what do we need to learn to mitigate those risks? I touched on this briefly in the previous slide, but we really want to understand the true size of the pain point, and how are people currently solving it? How much time and money are they investing? There may be, not in a direct competitor, but through indirect competition, people may be spending 6, 7, 8 hours trying to solve this problem in the course of their average week. They might be spending hundreds of dollars in ways that you haven't yet seen because you haven't taken the time to dig deep. Understanding how people are currently solving then leads us to need to investigate, how do we identify that right first feature or next feature to solve their problem? And have we done it in a way that they're going to pay for it? How are your users applying different mental models to what they're buying, both around similar products and other purchasing behavior in their life? Also, what does it take to actually sell this? Sometimes we have a, if we build it, they will come mindset. But if we can test how we think they'll come to us and get clarity on the right traction channels before we spend too much time building funnels to nowhere, we can get very, very laser focused on how we build our funnels and our growth loops. And who do we need to hire and to sell and service these customers? Often we can find ourselves in a position where we don't have assumptions or hypotheses about this and build a huge amount of features that requires a lot of human capital to staff and service that we didn't plan for and don't have the runway to accommodate. So what this looks like in practice is what we like to think of as the scientific approach. I don't know about you, but my favorite time of year in primary school was always the science fair. It was the one time of year where you could be absolutely dead wrong and fail and still get an A+ on your assignment. And while that might seem very rudimentary, that's the de-risking mindset that we apply to venture building. When we can break down the problem, gather data, use early data to form a hypothesis, conduct quick tests, and evaluate those findings, then we can quickly apply the learnings in a way that allows us to get out of assumption mode and get into de-risked, validated product building. But it's not just because we enjoy science that we think this is the right way to build. If there are any other Adam Grant fans in the room today, you may have seen this graph before in his most recent book, Think Again. In the book, he highlights an example about what happens when we challenge our assumptions when we build ventures. This is an example from a group of Italian companies, both a control group and then a group that embodied the scientific thinking that we just talked about before, this de-risking testing mindset. And when you look at the average total revenue for the year, yes, these dollar amounts are low, but these were idea stage companies. And the ones that didn't apply the scientific thinking and just kept going with their own assumptions made a very small fraction of what the companies that deployed scientific thinking were able to earn. And if you think about the rate of pivoting to the business,
Your shared screen isn't switching slides. Do you want it to? You might need to on-screen share and go back. There's a few comments in the chat.
Oh gosh, thanks, Lizzie. I apologize. Thank you for bearing with us. Like I said, some tech difficulties today. I promise that we'll share the slides with you after the session as well. Give me just a moment. Let's see if we can rectify this. All right, if someone could give me a verbal cue if we're back in business.
Back in business.
Excellent. Thank you everyone for bearing with me. So now that you can actually see the graph that I was referencing, you can see that there is a huge gap in what these teams were able to accomplish in under a year when they employed scientific thinking. And not only is the revenue the important point to highlight, the rate of pivot was more than double for the companies that employed scientific thinking. And we know when we can pivot rapidly, we can get to the right opportunity to serve our customer and our market. So how do we do this tactically? I think it can be very challenging when you're in the day-to-day, especially in the founder seat, where you're just trying to get to that next milestone where you can prove out that you're ready for an infusion of capital, whether it's your first friends and family round and you need to be able to have something to show your network that says, this is more than just an idea I shared with you over Thanksgiving dinner, or you've raised a seed round and you need to unlock that next level of growth, traction and growth to raise your Series A. We need to slow down the train a little bit. And I know that can feel counterintuitive to some, but the analogy I like to use is what I call the slingshot analogy. When we apply the scientific method and this de-risking methodology, it can sometimes feel like we're taking a step backwards. Like, why are we pausing when we have to be going this way? But what happens if you don't build the momentum for what you're trying to launch? It falls flat. But if you think about how we might load something into a slingshot, like a paper ball, when you pull backward, what I call that is the beautiful tension. We're building the tension, we're learning what we need to learn, and then when we release, it flies much further than had we not put additional power behind that item that we're launching. And I use paper ball because that feels much better than launching rocks into the air. But the first step is just taking a beat and asking ourselves, what are the biggest assumptions that we're holding? And then how do we translate that into a quick test so that we can get out of our own way and find those micro and macro pivots that allow us to unlock the traction and growth we seek? One quick formula we like to use is this little Mad Lib, where we ask ourselves, what are our core assumptions? Who are we assuming this about? And how is this going to impact our business? So as you can see from this example, we believe that certain medical appointments and consults for people who can't leave the house will result in more telemedicine usage on our app. And we use this example from a telehealth company that we were working with, and we tried to make it vague so as not to identify them. But the team had an awareness that there were specific specialties that were impacting people who had a harder time leaving the house than other patient populations. And if we could validate that these specific issue areas that patients were having were the ones that would drive them to seek telemedicine support, that we could put product strategy and go-to-market strategy behind that validated assumption or hypothesis. So this is one way we think about gathering data, and I want to acknowledge that there's a million other ways that we gather data, depending on the stage, the hypothesis, and the vertical of the company. There's a million different variables, but this is just one example. We might, in this order, conduct some user surveys, translate our learnings from those surveys into pointed specific questions that we can explore through ethnographic interviews. Take those learnings and connect with subject matter experts in the space, and then synthesize and document. And when we talk about document, it's not just putting it in a deck or a brief and leaving it in your Google folder, but document in a way that translates into your user stories, your marketing strategy, and your revenue model. Other ways that we might gather data are through marketing and growth tests, sales conversations. There's a million different ways to gather the right data at the right time. And we're always happy to talk about that in a one-on-one office hour. So if you are a founder who's looking to raise capital, what does it mean to apply this de-risking mindset, and how do you leverage it specifically for your capital raise? Demonstrating this de-risking mindset signals to investors that you're capital ready. If you can intelligently talk about the different hypotheses that you've held, how you've tested them, what insights you gathered from those tests, and how rapidly you applied them and in what ways, you are demonstrating strong evidence that you've got a meaningful solution, that you've got a well thought out plan for acquisition and growth, that you've got a revenue model, even if it's just hypothetical at this point. Having some data points about how you've tested your revenue model to date can make or break a good investor conversation. Having a comprehensive plan for how you deploy your capital is huge. Often we build those numbers from assumption, but if we've tested and validated some early ideas around how we might grow our user base, or what talent we need to build and service the validated product, then we can get very specific about how we'll deploy the capital that we're raising and how that translates into future growth for the company. And then, of course, from talking to your users and validating and testing, you've got a compelling narrative that you can offer to prospective investors. One example when we talk about de-risking is this idea of a well thought out acquisition and growth plan. Rather than assuming we know where our users are going to come from, we can show through tests that we have early evidence that these are the right traction channels. And we know that projected, roughly, we might be looking at this customer acquisition cost, or CAC. And then we can show our tests that reinforce our early hypotheses around the acquisition loop and the retention loop that helps mitigate some of the investor questions that might pop up around acquisition and retention. This is particularly important if you're a founder who comes from a historically underestimated founder identity. There's a lot of research that shows that founders with different identities receive more prevention than promotion questions. And if we employ the de-risking testing mindset when we're building our companies, we can position ourselves to answer those prevention questions with promotion answers. We can also gather insights that lead to a clear revenue model and projections. Those insights allow you to put together a model like this that's actually rooted in evidence that you can talk about. And this is just a little snapshot, and we can talk more about the different tools we have for how you might apply your learnings to a revenue model and projections, but being armed, even in your earliest days, with validated hypotheses around your revenue model and what type of growth you can experience will lead to more productive conversations with investors. And then, of course, we talked about the comprehensive plan for capital deployment. So how do you leverage this when you're building relationships with potential investors? How do you bring forward that you are embodying a de-risking testing mindset in the way that you build? It's easy. Show your investors you're de-risking your assumptions before asking for money. And I know that a million people give this advice to build relationships with investors and investing teams before you're asking for money. And often the question that we receive, and that I had myself the first time I was building my own company, was how? Especially if you believe in building authentic, real relationships and not just transactional relationships, which is huge in the earliest days of your company, because if you're giving equity on your cap table in your earliest days, you really want to have strong relationships with those people who now have ownership in your company. So tactically, let's talk about how you use your de-risking mindset to build relationships. Set up a meeting with an analyst or an investing partner at one of the target VCs that are on your list. Ones that are market aligned, right? We want to make sure that we're prioritizing investors whose thesis matches what problem we're solving in the world. So when we find those right VC firms, set up time with the analysts and investing partners who are in the weeds of your vertical and ask them for advice. Give them an overview of the assumptions you're going to test and how you're going to test it. Showing a plan and showing how you're going to get to the answer gives investors an inkling into the type of founder you are and how you run your business. Follow up after that conversation. Let them know what you learned and how you're going to apply those learnings across your product, your growth strategy, and what future tests you're going to run. When you've got those insights built up, you can use that to build a new version of your deck and ask them to share it with the GP, and also continue to be in relationship with that analyst for insight and support. Now, I know it's not just founders in the room. So as an investor, you might be asking, well, what can I do to increase my ability to assess a founder's de-risking mindset? And for the companies that are already in my portfolio, how do I help them grow their de-risking and testing mindset? This is a question a lot of our VC partners have been exploring with us, and we're excited to share back our frame on how you do this. It starts at the beginning, during your initial exploration, before you decide into diligence. Setting the right expectation out of the gates in how you talk about your fund in your diligence process is really important. Whether it's on your website or in a pre-read you offer to prospective portfolio companies before that first call, outline what a de-risking mindset means to you. What types of tests and validation points are you looking for from your early stage founders? And when you're investing pre-seed and seed, we know that revenue is often not the leading indicator or signal that you can use to determine whether or not something is investment ready. Communicate that you're going to be looking for that evidence that they've gathered by learning from their customers, and also wanting to see step by step, kind of a peek behind the curtain about how they do the testing in-house. It's also helpful to share resources on frameworks you're using to evaluate the de-risking mindset, whether that's articles written by other leaders in the space, examples of current portfolio companies that have embodied the de-risking mindset and what that's led to for their companies, or simply sharing your own experience embodying the de-risking mindset in your own professional journey as an investor, whether you were previously an operator or how you think about it in this current role as an investor, can be really important to signal to prospective portfolio companies that this matters for your fund or for you as an angel investor. Another way that you might demonstrate and test for the de-risking mindset in the earliest stages in this initial exploration is creating a transparent rubric for founder evaluation that centers on some of this methodology. If we can create transparency for founders around how we're evaluating them, it helps give them insight about what actually matters. We know in the startup ecosystem, there are lots of false indicators of success, like how many pitch competitions you've won, how many accelerators you've participated in, but that can often lead to an illusion that product market fit is closer than it actually is. So if we can signal to the ecosystem and to the prospective portfolio companies that actually these validating tests are the things that matter most because they are going to unlock growth and revenue, then we can help founders focus their time in the right way. And then another thing that we love that's really easy is make your diligence memo template public. Even if you're not going to create a whole new rubric around this de-risking methodology, Be transparent with founders around how you're going to evaluate them more broadly so that they can think about whether or not they've got the right metrics based on your diligence framework. Now, during diligence, there are ways to lean into the de-risking mindset and really suss out how well the founder and founding team embodies this. Some questions that you can introduce in your diligence process are around asking the founders and the founding team to identify point blank the assumptions that they're building around. Ask them how they're turning them into testable hypotheses. Ask how they're testing. Ask for concrete examples of moments when they've tested hypotheses and what the outcomes were for the company. We also want to know that a founder and the founding team is willing to be wrong. That's core to the de-risking mindset. So let's unpack further when founders have run tests and been wrong in ways big and small, and how they responded to that and what that unlocked in terms of growth for them as a leader, for the product, and for the company more broadly. Let's identify times where they've saved themselves from building the wrong feature. And if this is in the earliest days of the company, in that pre-seed or angel friends and family phase, we want to learn about how they got clarity on what they're intending to build and where they were wrong about what they're intending to build. And then let's learn about how they're testing out their marketing strategy before investing in a launch at scale. Another thing that we're looking for when it comes to de-risking mindset is the core executive habits that reflect or are leading indicators of a testing and de-risking mindset. I'm sure many of us have a point of view about what that is, but from our experience, we find that executives that have some core habits around being able to effectively lead and communicate what testing cycles are happening, and having a team where everyone on the team, whether it's one co-founder or a team of 20, can articulate the hypotheses that are currently being tested and think about it and articulate it themselves in that type of frame. The leader at the top shares that mindset with the team and can make it spread like wildfire within the company. We also want to evaluate their ability to quickly translate insights from the tests and apply it across the business. That's a core executive habit, because if we keep learning but not truly applying those learnings, we actually haven't learned much at all. And we encounter founders quite regularly who are trying to bridge that gap. They do the learning but are struggling to figure out, how do I, as an executive, take those learnings and apply them rapidly? And then more broadly, we look for curiosity, low ego, and a problem and user focus as leading indicators of a de-risking mindset. During the diligence phase, another way that you can support this is by sharing back your diligence memo and or rubric that you might be using, whether or not you invest. If we can give founders greater insight into what we mean and what the criteria and threshold is for true testing and de-risking mindset, we can unlock greater momentum for our founders. And then lastly, post-investment. Once a team has been invested in and they're part of your portfolio, when we ask for our regular updates, make sure that you're asking for updates that include information on the testing cycles. We want to know, what are the current hypotheses that you're testing? What are the ways that you're testing them? And then share back, what have you recently completed testing on and how are you applying that? If you're getting monthly or quarterly insights from your founding teams, you'll get a sense of what momentum is being made on this testing journey that they're on, and give you greater insight as an investor about how you can meaningfully support your portcos. And then to that point, provide platform support to further develop testing and de-risking mindset. Panel conversations are great, but how do we go a step deeper? Bring in subject matter experts to do office hours with your team to talk about this type of de-risking and testing methodology. Offer de-risking intensives, week-long opportunities that allow your portfolio companies to go deeper to learn and apply the methodology with a specific time-bound use case. We know that this was a cursory, top-level introduction to the concept, and so knowing that there are so many different lenses on this exact topic, we'd love to keep the conversation going. If there's anything here today that you want to dig deeper on for your specific use case, whether as a founder, an investor, or another friend of the ecosystem, let us know. We're here to support. We really believe that when we can help more investors win, it's better for the entire ecosystem. So with that, if there are any questions, happy to take those questions from you now. All right, this is a great question. Does pivoting ever portray weakness with investors? That's a phenomenal question. And there's a range of answers here, but I'm going to give you my point of view and the point of view that I feel most aligned with. Smart pivots are never a sign of weakness, but that emphasis is on smart. I've encountered countless founders who pivot because they feel some fear or anxiety about whether or not they're going in the right direction. That's normal. Sometimes it takes a while for a strategy or tactic to pay off. And when we want to see immediate results in the first week or 2 weeks of something that we have live, fear can lead us to make a pivot without any data that encourages the pivot. So when we think about how to make a pivot in a way that signals strength to an investor, we want to do it in a data-driven way. So if you've got a product out in the world right now and it's not performing the way that you want to, before you make a radical pivot, think about ways that you can do low-dollar, low-fidelity tests that build the evidence for the type of pivot that you think could be transformative for your business. One way that you might do that, I'll give an example with a B2B SaaS product that I worked with in California. It wasn't originally a B2B SaaS product. Originally, we started as a B2C SaaS company. And what we found was the KPIs that we would use to evaluate product market fit clearly indicated it simply wasn't there. The actual acquisition numbers were in the single digits and retention even lower than the acquisition rate. And we couldn't keep users beyond 30 days. So it was clear that we weren't solving a meaningful problem in the B2C strategy that we were employing. So before we decided to blow up the entire strategy, we continued to service the product and the market as we were in that moment, while concurrently spinning up some splash pages and having some B2B sales conversations where we had 3 core hypotheses about different business cases and types of businesses that we could use existing product to service and solve problems for in a meaningful way. From those 3 tests, we got pretty clear insights on which of those B2B use cases were going to be our strongest path forward. We were able to go back to the investor team at the seed round and say, here are the data points that we've amassed that indicate this is the right pivot for us. And it was easy to get buy-in because we had done that testing. The testing cycle had been about 6 weeks long, and we had enough insight where they could see that there was some rigor that we developed around the case for the pivot. If you've got more questions about how you position the pivot in a way that gives you a strong position with investors, happy to have a conversation with you. Okay. In regards to risk management, when a significant risk is identified, but may be cost time intensive to deal with, what are the best strategies to address it effectively? This is a phenomenal question, Connor, and I wish I had a one size fits all response to this. It depends on the type of risk. It depends on the risk is based on the user persona that you're pursuing, a specific product feature that you've built that isn't going to work, a significant threat that's entering the market. But our mindset is always to create a range of scenarios quickly that could address it effectively before spending too much time and money pursuing one specific solution, unless the solution is very on its face and very clear. What we are able to do when we take a beat to put together some hypotheses about ways to solve the risk, we might find that through our testing, the initial solution isn't the right one, but we can discern the kernel of truth that puts us on the right path. Depending on the size and nature of the risk, there comes a moment where you have to ask yourself, how big of a pivot do we need to make in order to address it? And is it worth investing more time and capital? I'm always very clear with teams that sometimes the answer is that this idea was a great learning and not the idea that I want to put time and capital in pursuing. If there's something specific that you're navigating around risk management in your own journey, let me know. I'm sure you probably don't want to disclose on a recording what you're navigating, but if you want to talk specifics, I'm always happy to help. Sophie, great question around what is considered a successful product market fit journey or destination. So it's definitely a journey, certainly not a destination. Or you can think about it as mountain climbing, where there's different peaks that we hit before climbing to the next summit. A successful product market fit journey is one where you are constantly gathering insights from the user, and if the user and the buyer are not the same, both your user and buyer, as well as the market, and finding new ways to delight the user in a way that leads to more revenue and getting to the point where your user is evangelizing. We know we've got real product market fit when your users are telling their friends to use your solution. There's nothing greater than that moment where you realize that you've built something that isn't just Sophie who's using it, but Sophie's now brought along her friends Dane and Connor and Laura and Liz, and it means that we've really hit on something. But as I stated way back at the top of my presentation when my slides weren't fully loading, product market fit is not a one-time occurrence. So we need to keep this loop happening in an ongoing way. Lizzie mentioned our colleague Nick's session about how to build a product market fit engine. He's going to dive a lot deeper into this topic in a virtual session on Thursday. So if you've got time on Thursday, I highly encourage you to join him. Jane, it looks like we have a question here from a founder inventor and who built the product themselves in the garage. Is it sensible to launch the product as a method of market research, building 10 products and seeing if they sell, then making more as needed? That's a great question. And depending on the type of product that you've built, well, first, congratulations on being an inventor. It's no small feat to generate new ideas and to build new products. When it comes to how we might test the market, if you've got a very capital intensive product that you're building in your garage, before you go build 10 of them, what you might want to do is create an easy way to test demand. It could be social media ads, seeing how many click-throughs you get. It might be a splash page on the other end of those social media ads where people can sign up for an update when more product is released. And what you can discern there is one of two things. Either there's a clear demand for the product as you've positioned it, or there isn't a clear demand for your product. And that can lead to two new hypotheses that you have to go test. Is it the positioning of the product, or is it the product itself? Or third wild card, maybe I'm not talking to the right people. So depending, again, on how capital intensive it is to build your products, you might want to take this further upstream approach to test demand before you invest in materials and the time to build. Brian, great question around best ways for founders to network and find analysts and investors in the startup funding ecosystem. It's really hard, and it can feel kind of like, trying to stumble through the dark and hope that you lock hands with someone without being able to see. There's a few strategies and tactics that I really like. I'll go into a couple of them, and I'm always very clear that there are a million more, and certainly many more that I probably haven't thought of or encountered yet myself. The first is just going to and being present at ecosystem events. I think especially after the past 2.5 years that we've experienced, people, if you feel safe being in public spaces, people are really yearning to be together in person. I'm based in Chicago, so not in the Twin Cities, but I do believe Midwest is best. And in our ecosystem, there's been a deep yearning to be back in person together. And great cross-pollination at in-person events, if you can find the right in-person events between founders and investors. Twitter, I know that Twitter can be kind of a nightmare for people to hang out on. I was very resistant to getting back on Twitter for quite some time, but you can actually find meaningful relationships with investors and early stage investors on Twitter. And by early stage, I mean both in terms of stage of the fund, but also people who are emerging in their career, who might be analysts just getting started or with a couple of years under their belt, who are looking to meet with founders like you who are also getting started on their founder journey. Also, when you think about the funds that you're pursuing, and we really encourage founders to take a lens around alignment, around thesis, stage, and culture. If you've identified 10, 20, 30 of those funds, go to LinkedIn, find those analysts on the team and reach out directly. The beautiful thing about this industry is it's not just welcoming, but encouraging of the cold outreach, which I know can feel challenging for those of us who don't love cold outreach, but it took me a while to cultivate the muscle to realize that there are far more people than I thought who wanted to hear from me, who had never heard of me before. And then lastly, I'd encourage you to ask your network. If there are other founders in your network who are out raising capital or who've previously raised capital, they've undoubtedly made contact with a lot of analysts and early investors who might be a good match for you to connect with, and a warm intro is never a bad thing. Happy to talk more about how you might identify and target your list offline if that's helpful. And Lizzie shared a link to my Calendly, as well as the QR code that's on the screen that will take you to the Calendly. So always happy to talk about these topics or anything else that comes to mind when it comes to early stage venture building. I know we're coming up to the top of our time together today. I'm happy to stick around for a couple more minutes to answer your questions. I'm sure people might need bio breaks between now and their next session, so I will not take it personally if you have to hop here, but happy to answer any other questions that might be coming up for the folks who want to stick around. All right. Well, we can call it a wrap here. I'm really grateful that you chose to spend part of your Twin Cities Startup Week experience with me here on Hopin. I hope to connect with all of you. Even if you don't have an immediate question, please find me on LinkedIn. I'm always happy to connect and share who and what I know with you, and always thrilled to spend some quality one-on-one time with you as you navigate your journey through the ecosystem. Thanks, everyone.